Are you confused about the differences between mutual funds, index funds, and ETFs? If that's the case, then don't worry because you're not alone. These terms get thrown around a lot, and sometimes they're even mentioned as if they're the exact same thing, which they're obviously not. Now, although they are very similar investment vehicles, there are still differences between them, and they all have their pros and cons. In this video, I'll go over what is a mutual fund, what is an index fund, and what is an ETF to help you understand the differences between all these investment vehicles so that you can make an educated and informed decision before investing in any of them. If that's what you're looking for, then be sure to watch this video all the way through. Hi guys, my name is Marius and welcome to Money Employed. If this is your first time here and would like to join our community of money employers and finance junkies, then make sure to subscribe. Also, if you enjoyed the video, please give it a like because it really helps out the channel with the YouTube algorithm. It takes no more than 5 seconds to like and subscribe, and I would really appreciate it. And yes, I am filming in a different setting today because my old camera died on me and the new one's not gonna arrive anytime soon with everything that's going around. So for now, I'll be filming with a streaming webcam. Yay! Anyway, let's get into the video. So we'll start off with mutual funds because to understand what is an index fund or what is an ETF, we first have to understand what is a mutual fund. This investment vehicle has been around for a long time, and some argue that the first mutual fund was first created in 1774 by a Dutch merchant called Adrian van Ketwick. I think I got that right. Then this investment vehicle started becoming more popular across Europe over the next 100 years and eventually reached the US by the late 1800s. Although the modern mutual fund that we know and use today first appeared back in 1924 in Boston. So what is a mutual fund? Basically, a mutual fund is an investment vehicle that pulls money from a collection of investors to invest in things like stocks, bonds, and other securities within a portfolio. And there are 3 main reasons why people like and use this investment model. Firstly, it's because investing in a mutual fund offers convenience. Now, what do I mean by that? Well, when you invest in a mutual fund, you essentially become part owner in all the stocks, bonds, and other securities that are owned by that mutual fund in its portfolio. So with only one investment, you can benefit from owning tens, if not hundreds of stocks, for example. If you wanted to buy the same number of stocks found in a typical mutual fund, it would take you a long time to do it, it would cost you a ton of money, and not to mention all the trading fees that you would have to pay. And that's what I mean by mutual funds offering convenience. Now, the second reason why people choose to invest in mutual funds is diversification. Basically, by owning a collection of investments within your portfolio, you get to spread your risk across multiple companies and sectors of the economy. Instead of having all your money invested in just one company, for example, you would have it spread out across many different ones. So if one or more stocks in the mutual fund are doing badly or have gone under, there are other ones in the fund that will pick up the slack in a way to balance things out and minimize the losses. And the third reason why people choose to invest in mutual funds is because they're typically managed by investment professionals. These professionals are referred to as fund managers, and they're responsible with picking and choosing investments for the fund. Since most people don't want to analyze individual companies to invest in, for example, or they don't even have the right education to do this, they would rather leave it to an investment professional who can do careful research and skillful trading on their behalf. Now, there is a fourth reason why people invest in mutual funds, and that's because usually workplace pensions take the contributions and invest them in these mutual funds. But it's not typically by choice, and that's why I didn't want to mention it initially, but I think it's important for you to know that. So far, mutual funds sound like a good investment strategy because you benefit from the convenience they offer, the level of diversification that you can easily achieve, and because they're typically managed by people who know what they're doing, right? Well, yes, that is the case, but the last point is what makes mutual funds undesirable, in my opinion anyway. If one or more fund managers are picking and making investments for the fund, that means that the fund is actively managed, which in turn means that they will typically have higher fees. The way mutual funds charge you for the privilege of investing your money with them is through an annual fee called the expense ratio. And the average annual expense ratio for mutual funds can range anywhere between 1% and 2.5%. For example, if the expense ratio is 1% and you invest, let's say, £1,000, you will pay £10 in fees just to cover the fund manager's services. Now, 1% might not seem a lot, but over time, that can add up to be a significant amount that you will have to pay in fees alone. Sometimes it can amount to tens of thousands of pounds or dollars. And get this, whether the manager or managers make good or bad investments, you will still have to pay them their fees. So to pay someone a good chunk of your money, even when they lose you money, is just daylight robbery to me. And this is where index funds come in to kind of save the day. On December 31st, 1975, John Bogle, who was the founder of the Vanguard Group, created the first index fund. By doing this, he completely revolutionized investing for millions of everyday investors like you and me. But what is an index fund and how does it work? Basically, an index fund is a type of mutual fund, but it's passively managed. So instead of having a fund manager that does active stock picking and investing, an index fund follows a fixed formula by which it tracks a market index such as the S&P 500, which is one of the most followed indices in the world. A market index is a hypothetical portfolio of investment holdings which represents a segment of the financial market. And basically what an index fund does is it buys securities that make up the index that it tracks. So an index fund that tracks the S&P 500 will invest in most, if not all, the companies that represent the index. And by investing in one such index fund means that you become a part owner in 500 of the largest companies in the US. These are all spread across multiple sectors, and that means that you have a high level of diversification. Unlike traditional mutual funds who try to beat the stock market or a specific index, i.e. the S&P 500, index funds are designed to simply mirror the performance of a specific index. That means that when the value of the index goes up, so does your investment pot, although the same is true when the value of the index goes down. But by investing in index funds, you're almost guaranteed to make the same returns of the index that the fund follows. And this is one of the two main reasons why index funds are better than mutual funds. But let me explain why that's the case. Choosing good investments that will make a great return and beat the stock market is not that easy. Especially if you're an everyday investor that doesn't have the time or experience to pick individual stocks, for example. But would you be shocked to know that 95% of finance professionals can't beat the stock market consistently over time? I mean, we're talking about the best people in the field. So if so many of them can't do it, why bother paying them ridiculous annual fees? It just doesn't add up and it doesn't make sense, at least to me. And here comes the second reason why investing in index funds makes much more sense than investing in mutual funds. Because index funds are passively managed, that means that there is less overhead, which in turn means less costs. Less costs means lower expense ratios that you have to pay to invest. But how low are we talking? Well, the typical expense ratio for an index fund is about 0.2%. And for an index fund that tracks the S&P 500, for example, the expense ratio can be as low as 0.04%. Yes, it might be surprising, but that's how low the fees are. So allow me to demonstrate how much more you'd be losing by investing in an actively managed mutual fund versus investing in an index fund. Let's assume that the expense ratio for the regular mutual fund is 1% and 0.2% for the index fund. And let's say that your investment horizon is 40 years, okay? For the purpose of this example and to work with easy numbers, let's also assume that the average annual return of both funds with dividends reinvested and adjusted for inflation is 10%. And let's say that you will be investing $10,000 every year for the next 40 years. I'm gonna use dollars because most people are more familiar with that currency. Anyway, when investing through the index fund, we take the annual return of 10% minus the 0.2% expense ratio, and we're left with a return of 9.8% per year. So far so good? Cool. Now, if we run the numbers, it turns out that in 40 years, your investment pot will be worth just over $4.6 million. And we'll just copy and paste this number over here. Now let's do the same with investing in a regular mutual fund, charging a 1% expense ratio annually. Our 10% annual return turns into 9% and we'll update that in the calculator. After running the numbers, it appears that your investment pot will be worth just over $3.6 million. If we do a quick calculation, it turns out that over the 40 years of investing, you end up spending more than $900,000 in fees only. Now that's just insane. But you know what's even more crazy? The fact that the majority of actively managed funds can't even match the performance of the stock market, let alone beat it over time for the next 40 years, for example. Even if they did manage to match the performance consistently for such a long time, which clearly won't be the case, they would still underperform for their investors because of their high fees. So far we've learned what mutual funds and index funds are and how they work. Also, you might have realized that all index funds are mutual funds, but not all mutual funds are index funds. And if you want a quick way to distinguish between them when looking for funds to invest in, an index fund will always have in its title the words index or index fund. And to double check, check, I highly recommend you always read the key investor information document, which will tell you exactly how the fund works and what are its objectives. So now let's move on to ETFs, which stands for exchange traded funds. These investment vehicles have been around for about 26 years now, and they're a close cousin of the index funds. Basically, most ETFs are index funds and they track the performance of a specific index, and they also have low annual expense ratios, and in some cases they can be even lower than the ones of index funds. But unlike index funds, which can be traded only once a day when the market closes, ETFs can be traded on a stock exchange during market hours, just like shares of companies, aka stocks. This gives you, the investor, more flexibility and liquidity if you need to sell. However, although that can be a benefit, it can also be damaging to your returns, because you might end up spending a lot of money just in trading fees. Not only that, but because ETFs trade like stocks and you can see their price going up and down, that can trigger impulsive buying and selling, which in most cases won't help you get better returns long term. But if you want to take advantage of market fluctuations and be more of an active investor, ETFs will allow you to do that. So if you're looking to invest consistently over the long term with minimal effort, low fees, and no temptation to buy and sell, then investing in index funds makes the most sense in my opinion. That's also because index funds automatically reinvest dividends, unlike most ETFs. So just to recap, we learned that mutual funds are a way for investors to pull their money together towards buying securities such as stocks. Mutual funds can be actively managed and have high fees, or they can be passively managed, as in index funds and ETFs, and have lower fees. And while actively managed funds try to outperform the market, index funds and ETFs simply try to match the performance of the index that they track. But which one of them should you use? Well, it's not my place to say, because I'm not your financial advisor. I'm just a guy on YouTube who likes to talk about this stuff. I personally use index funds, but I also invest in individual stocks as well. But index funds are my main strategy for investing in the stock market. And maybe index funds are the best option for you as well. Who knows? The best advice I can give you is to speak to a professional, because they'll be able to guide you based on your own circumstances. Having that said, guys, I really hope you enjoyed this video and got a ton of value out of it. If you have, please make sure to hit the like button, because it lets me know that you guys enjoy the content that I put out. Also, if you want to show your support for the channel, subscribing and clicking the notification bell really does the trick with the YouTube algorithm. By the way, if you want a free stock, use the link in the description below to sign up with Trading 212, and they will give you a free stock valued up to £100 when you deposit £1. As always, comment your thoughts and questions below and let me know if there's any particular subject that you would like me to cover in the future. Thank you so much for watching, and I'll see you guys in the next video.